Assalamualaikum everyone. Good evening. How's everyone? Welcome to the day 3 session. Today we will discuss restructuring topic. Before we start the topic, if you have any question, do let me know. अगर किसी का कोई भी question हो, do let me know. Any question, guys? Okay, let's discuss that how this topic can be tested in exam. First of all, I will discuss the numerical version. Then I will discuss the theoretical one. So numerically, this topic can be tested in many ways. For example, first question examiner can ask you to make a liquidation statement. Liquidation statement, that is, calculate realizable value of assets. Calculate realizable value of assets and estimate that how much each party will get in case of default. So what you will do, you will calculate the realizable value of, for example, property, plant and equipment. You will calculate the realizable value of inventory. You will calculate the realizable value of receivables. You will write all, and then you will distribute the total, distribute this to all stakeholders hierarchy wise. First of all, you will distribute to secured creditors, then unsecured creditors, then preference shareholder, and then if any ordinary shareholder. Obviously there will not be left anything for ordinary shareholders, but hierarchy is like this. This should be the hierarchy. So this can be tested even in last attempt question. We will solve that question after a few minutes. Examiner has asked this thing. So maybe in exam you have to calculate the realizable value of asset. Okay, second question that examiner can ask, that make balance sheet. Obviously the name of balance sheet is statement of financial position. This can be tested in two ways. First scenario, that is, make statement of financial position just after restructuring. Just after restructuring. Make a balance sheet make a new income, make a new statement of financial position or balance sheet. So it can be tested in two ways. Number one scenario, make statement of financial position just after restructuring. Okay. In that case, what you will do, you will exactly copy the last statement of financial position from question to Excel. Exactly copy the last statement of financial position to the Excel. Okay. Then read the text and do all adjustment in statement of financial position. Remember, every adjustment has two parts. One will be the debit part and other will be the credit part. So you will make the income statement. For example, first of all, non-current assets, current assets, total, equity, non-current liability, current liability, total. Okay. For example, if examiner says there is an increase in non-current asset, if there is an increase in non-current asset, it must be financed either from the non-current liabilities or from the cash. If there is an increase in inventory, current asset will increase, but at the same time, cash will also decrease. If there is an increase in equity, it must increase the cash. If there is an increase in non-current liability, cash will increase. Remember, there will not be any change in the reserve immediately. Retained earning will not increase because you are making the balance sheet just after restructuring. Just after the restructuring. So in first scenario, if you are making the balance sheet just after the restructuring, you will directly make the balance sheet. You will not make any income statement. Income statement nahi banani aap. You will directly make the balance sheet. So how to make that? It is not like SBR or FM, FR paper that you should start shivering that, okay, I have to make the balance sheet. It's a big tension. No. Copy the last balance sheet in your Excel, read the adjustment and do the adjustment. Hardly there will be 3 to 4 adjustments. Hardly. If there is an increase in non-current asset, cash will decrease. If there is an increase in inventory, cash will decrease. If there is an increase in liability, cash will increase. It's a simple adjustment. And if you are unable to balance a balance sheet, put the balancing figure in the cash. And if information of the cash is also available and you are still unable to balance a balance sheet, put the difference in the reserve. Put the difference in the reserve. That's how you will do it. That's the first scenario. Okay. What about the second scenario? Second scenario. Second scenario is make statement of financial position after 1 year. So what you will do in that case? First of all, make income statement. Make income statement first. And then make balance sheet. First of all, make the income statement, then make the balance sheet. And remember, non-current asset, current assets, total equity. And now in reserves, add the retained earning from the income statement. Add the retained earning from income statement. Then non-current asset and then current asset. That's the difference if you are making balance sheet just after 1 year or just after the restructuring. If you are making the balance sheet just after restructuring, no income statement will be required there. There is no need to add retainer. But if you are making balance sheet after 1 year, firstly make the income statement and then make the balance sheet. And then add the total of the balance sheet, then add the total of the income statement in the balance sheet in the reserve column. That's how you will do it. Okay, that's the main point. And remember, whenever you are doing any adjustment, it will be adjusted in two ways. Either it will have a debit impact and either it will have a credit impact. Okay, next is question number 3. Make or forecast statement of comprehensive income statement. How to do it? Copy last year income statement from question and copy into Excel. Read the text and calculate sales cost of next year. That's how you're gonna do it. Previous year sale is given, next year sale information will be given. Previous year cost is given, next year cost will be given. Previous year profit is given, next year profit information will be given. Previous year interest is given. Now, based on the new loan, calculate the new interest. That's how you will do it. Okay, in some question, you need to calculate market value of the business or equity. Obviously, you know that how to calculate it. And in some question, you need to calculate certain ratios. Calculate debt equity ratio or gearing ratio, or in some question, it was equity to debt ratio. So how to calculate it? If it is for 1 year, then it is okay. If it is for number of years, calculate debt level of each year. Calculate equity level of each year. And now calculate debt to equity ratio. So maybe in some question, examiner can ask debt to equity ratio. You should know how to calculate it. And if you are calculating the equity level of each year, how to calculate the equity level? For example, these are the year 1, 2, 3, 4. First of all, make the small income statement. Sale minus cost minus expenses, operating expenses minus interest tax, profit after tax, less dividend, that is retained earning. And that retained earning should be added into the opening equity. That is equal to the closing equity. And then you will calculate the closing equity of each year. That is the equity level. That's how you will calculate the equity. Okay, that's how you will calculate the equity. So it may be, maybe in exam, this question can be tested. Okay. So these are the maximum numerical point which examiner can test. You know how to make the balance sheet. You should know how to make the balance sheet. You should know how to make the balance sheet now or how to make the balance sheet after 1 year. You should know that. You should know how to calculate debt equity ratio. Okay. Then very important part. Next question, very important part. Question number 6. Examiner will say he will give you certain cases. Case number 1. Okay. Forecast income statement is given. Forecast balance sheet is given. Examiner will give you certain cases and calculate the impact of those cases on the balance sheet and the income statement. Examiner will give you certain cases and calculate the impact of that case on income statement, balance sheet, and debt equity ratio. For example, case number 1. Raise funds from equity and purchase the asset. Case number 2. Raise funds from debt, purchase the asset. Case number 3. Raise debt from equity, pay back the loan. Case number 4. Raise funds. This is raise funds. Raise funds by selling asset and buy back equity. So what is the impact? Balance sheet, income statement, debt equity ratio. If you're raising funds from equity, equity will increase. Purchase the asset, non-current asset will increase. If you are purchasing the asset, return on the asset will increase. If return of the asset is increasing, current asset will increase. Okay. And if you are increasing the current assets, if the return on the asset is increasing, it will increase the current asset. And as the return on asset is increasing, ultimately, what will happen? Retained earning will increase. And that increase in earning will become part of the balance sheet. And what is the impact on the debt equity ratio? It will decrease. Raise funds from debt. Non-current liability will increase. Purchase the asset. Non-current asset will increase. Okay. Purchase the asset. Return on asset will increase. Non-current liability is increasing. So interest will also increase. And the net impact on retained earning. And that retained earning will become part of the balance sheet. And here, raise funds from equity. Equity will increase. Pay back the loan. Non-current liability will decrease. If non-current liability is decreasing, interest after tax will decrease. This is also interest after tax. And it will increase the retained earning, which ultimately has an impact on this. Raise funds from selling asset. Non-current asset will decrease. Buyback equity. Equity will decrease. And if you are decreasing the non-current asset, return on asset will decrease. Result, retained earning will decrease. Ultimately, balance sheet will decrease. So that's how it will work. So these are the 4 cases which can be tested in the exam. There's a question named ENIA. Examiner has already tested this. Okay, guys, let's have a look at the theory, at how theory can be tested. So I have discussed this part. Okay, there are few things which I want to discuss. Few definitions which are very self-explanatory. Let me explain it. Number 1 is leveraged recapitalization. Leverage means borrow. Leverage means borrow. Recapitalization means if you are repurchasing the share of your own company, that is recapitalization. Leverage recapitalization is you will borrow and buy back the shares of your own company. Okay, there is one question. Return on asset is an income statement. Return on asset, whenever you increase the assets, actually assets will generate income for you. So in almost all of the questions, examiner give you that if there is an increase in asset, it will increase the income by 5%, by 6% or 7%. For example, non-current asset has been increased by 100 million. And it is written in the question that return on asset will increase by 5%. So you will take the 5% of 100 million. That means income will increase by 5 million. And if it is a before tax, you will take its after tax value. And if it is already after tax, then obviously that 5 million is the increase in income. In accounting, you haven't read such kind of statement. But here, if you are increasing the asset, examiner will tell you that ultimately it will increase the income. Okay, I was talking about the leverage recapitalization. Recapitalization means to buy back the shares of your own company. Leverage means borrow. So if you're borrowing from the market and buy back the shares of the company, that is leverage recapitalization. So why companies do the leverage recapitalization? Company often do the leverage recapitalization as a defense mechanism so that they can buy the shares of the company, and enough shares are not available in the market. And if shares are not available in the market, so it will be difficult for the company to acquire it. Okay. Only those companies can do it where debt level is already low at low level. Otherwise, it is difficult for those companies where debt level is already at higher level. Then maybe in examiner can test the debt equity swap. So it can be a question that equity is swapped against, exchanged against debt. So remember, market value of equity should be exchanged against the market value of debt. Market value of equity should be exchanged against the market value of debt. Number one rule. This is rule number one. You cannot exchange book value of equity against the market value of debt. You cannot exchange market value of equity against the book value of debt. Market value of equity should be exchanged against the market value of debt. Rule number one. Rule number two. Market value of equity offer should be better compared to market value of debt. Why is that so? Because we all know that equity is risky. So if I am exchanging 100 million of equity against the 100 million of debt, that is totally unfair, right? This is secure, this is unsecure, this is less risky, this is risky. So if I am exchanging 100 million of equity against your debt, you will not be agreeing against the 100 million of debt. So how I will convince you? Against the 100 million, I should offer like 110, 120 million so that you can agree on my proposal. Why, sir? Why should I offer the higher price? Because equity is risky. If you want to get 100 million by giving the same amount of equity, nobody will accept this because you are a debt holder. I am the equity holder. I am saying I will give you 100 and your debt will be finished. Your debt will be ended. You will not agree. You will say, my loan is secured. Why I will accept the 100 million equity against the 100 million debt? So how to convince you? I have to offer some better term, more amount. That's the rule you should remember in debt equity swap. Okay, got this? Any question from this, guys? There is one question that what is the impact of leverage on debt equity? Debt equity definitely will increase. Leverage means borrow, loan. If you are increasing the leverage, debt equity will increase. Any question from this part, guys? Any question from this part? Okay. Let's move to the next. Leverage buyout. Leverage buyout is exactly similar to leverage recapitalization. But in leverage buyout, you will completely buy out the company, the whole company, and the company will become unlisted. In recapitalization, you will take the loan and buy shares of the company. In leverage buyout, you will take the loan and completely buy all the shares of the company, and the public listed company will become the private listed. Public listed company will become the private listed company. That's the difference between leverage buyout and leverage recapitalization. Okay. Why people do the leverage buyout? Protection from share price movement. Now, as the company become private, there will be no share price movement. No hostile bid. As the company become private, nobody can buy your company. Focus on long-term performance. Remember, all the private companies have long-term focus because publicly listed companies have to show their performance, have to prove themselves after every year. So agency costs will be lower. Shares do not trade publicly anymore. Bankruptcy if the cash flow risk is too high, because as a private company, you do not take much loan, or it is not easy for you to raise funds from the market. Okay. This is important. Unbundling is a process by which a large company with several different line of business retain one or more core business and sells off the remaining businesses. So, फरहान साहब ईशा की नमाज है, बाद में पढ़ लेना. ठीक है. So there are a number of definitions which you need to learn: divestment, demerger, sell-off, spin-off, carve-out, management buyout. You need to remember all these because an examiner can test maybe one or two of them, but this would be the straightforward testing. Divestment is actually the opposite of investment. Divestment is actually the opposite of investment. Divestment is a partial or complete sale or disposal of physical and organizational asset, the shutdown of facilities, reduction in workforce to free fund for investment in other areas. Why a company can do the divestment? Corrective action in order to reverse unsuccessful previous acquisition. So you want to make the correction because previously you have done some unsuccessful acquisition. Divestment may also take place as a response to the cyclical downturn. Like now at this point of year, majority of the countries in the world are in recession phase. So if you are offering a product which is no more in demand, what you will do? You will divest. Unbundling means you are selling some companies. Unbundling means this is your company and you have different businesses, like you are doing the textile, you have the cement, you are doing the fertilizer. In one name, you are doing three business. Unbundling is you are separating the cement, fertilizer, and textile. This is unbundling. You're keeping one or two companies under your umbrella and selling others. Or selling two companies, keeping one under your umbrella. That is unbundling. You are opening the bundle. Okay. And the number one example is divestment. Divestment is opposite of the investment. You are selling something. Why you are selling something? Because that product is not in demand. Because that product is loss making. So that's why you are discontinuing the product. Okay, demerger is the opposite of the merger. And remember, if somebody asks you, what is the reason of merger? If somebody asks you why merger, your one word answer is because of synergy. Why merger? Sir, because of synergy. And what is the formula of synergy? Combined market value of equity minus market value of acquired equity minus market value of target equity. That's the reason of why merger. And now if somebody is asking why demerger, exactly opposite, you will say, sir, if the market value of acquired equity, individual company, plus the market value of target equity, these are the separate value of the companies, is greater than market value of combined equity. You will say that, sir, if there is a benefit, sir, we will do the demerger. Demerger is exactly opposite of the merger. If market value of individual equity, if the market value of acquirer plus the market value of target equity is greater than the market value of combined equity, so why there is a need of consolidation? Why there is a need of group? Why there is a need of combined company when market value of individual companies are greater? So you should demerger yourself. Guys, this question can be tested numerically. Believe me, this question can be tested numerically. Examiner can test this numerically. There is one question on it in our notes. Question bank Romage, the name Romage. So please must do question. Examiner can test this. Although it looks like that this is a restructuring question, but examiner will ask all things about the revaluation. Sorry, the valuation. So it will be the mixture of restructuring and valuation question. Okay, advantage of demerger is, the main advantage of demerger is a greater operational efficiency. When you operate independently, having different management, your targets will be clear, your responsibility will be clear, your accountability will be clear. So maybe you will become more operationally efficient. That is a major benefit. The disadvantage of merger. The disadvantage of merger is exactly the opposite of advantages of merger. Economies of scale will go on. Smaller companies which result from demerger will have a lower turnover, lower profit, lower image. There may be a higher overhead cost. Ability to raise debt capacity will go on. Vulnerability to take over may be increased. As your company is smaller, so your company is more vulnerable for the takeover. Okay. Next is spin-off. Spin-off. Oh, sorry, sell-off. Sell-off is the sale of a part of a company to a third party. Sell-off is like divestment. Sell-off is a form of divestment involving the sale of a part of a company, usually another company. So if you are selling some individual asset, that is divestment. If you are selling the part of the business, it is sell-off. So why you are selling, what is the reason of sell-off? As part of its strategic planning, it has decided to restructure, concentrating management effort on the particular part of the business. Control problem may be reduced if peripheral activities are sold off. If you are focusing on the core area and you are selling the other areas, you are disposing of the other areas, that is the main reason of sell-off. It wishes to sell off a part of business which make losses. So that you are selling the loss-making business unit. That's a strategic decision. In order to protect the rest of the business from takeover, it may choose to sell a part of the business which is particularly attractive to a buyer. Guys, what is this? Can you remember the name of this? This was one of the defense. This was one of the defense which we have covered last day.
Crown jewel.
Crown jewel, yes, it's a crown jewel. It's a crown jewel. That may be the, although it's not a major reason, but it could be the reason. Company may be short of cash. That's why you are selling one business. Subsidiary with high risk, so that's why you are selling it. Subsidiary could be sold at profit, so that's why you are selling. Okay, we are selling the subsidiary at profit. Liquidation is an extreme form of sell-off. You are selling the business in parts in such a way that that business is not a going concern now. Liquidation is like the extreme part. Next is spin-off. Two definitions are important, spin-off and carve-out. Let me explain it, then I will read from here. spin off, carve out. So this is your business. You are doing, you are handling two divisions. For example, textile and for example, cement. What in spin off, what you will do? You will separate the cement business, make a separate company, make a new company, cement, make a new company, make a new management, and give all shares of new company to old shareholders. That is spin off. But in carve out, you will sell shares to new shareholder to raise fresh money, to raise fresh funds, and keep remaining shareholding to previous shareholder. So that is the major difference. In both spin off and carve out, you will make a new company. Management will be new targets, new allocation, new accountability, responsibility. But in spin off, all the shares of the new company will be issued to the existing shareholders. So ownership will not change. In carve out, shares will be issued to the new shareholders and you will raise funds and you will give like 51% shares to the existing shareholders. So the existing shareholders will still remain the owner, but their control will dilute. Their control will dilute. In spin-off, a new company is created whose shares are owned by the shareholders of the original company, which is making the distribution of the asset. In a spin-off, there is no change in the ownership of the asset, as the shareholder own the same proportion of shares in the new company as they did in the old company. Ownership will not change. Why? The change may make a merger or takeover of some part of the business easier in the future or may protect part of the business from predators. So you are separating one company from another just to protect yourself or just to make a scenario so that it will be easy for you to acquire the other company. Maybe by keeping this company together, by keeping this company with you, you unable to get approval from the regulator. So by splitting off the companies, your company size has become lower, smaller. Now a regulator will give you the permission to acquire the other company. That may be the case. There may be improved efficiency. There may be improved efficiency and more streamlined management within the new structure. It may be easier to see the value of the separated part of the business now that they are no longer hidden within a conglomerate. Sometimes, guys, when you separate the business into different segments, it is easy for you to realize the value from all the divisions. Otherwise, if you are managing 2 to 3 divisions combinedly, jointly, some of the divisions will make money and some of the divisions will not make money, but you will not bother because others are making money. The requirement of the regulatory agencies might be more easily met. Okay, I have discussed the carve out. A carve out is a creation of a new company by detaching part of the company and selling the shares of the company to the public. In carve out, a new company is created whose shares are owned by the public with the parent company retaining a substantial fraction. So in carve out, you will make a new company. There will be a new management, but you will issue, you will keep few shares with yourself, substantial part, and you will issue the remaining shares to the public. That's how carve out will work. So what about the management buyout? This is important. In management buyout is the purchase of all or part of the business by its manager. There are two definitions here. One is management buyout. Other one is management buy-in. So what is management buyout? If your management purchases all the shares from the owners and start running the new business under their control, that is management buyout. If the external management acquires the business from your company shareholders and start running the business, that is management buy-in. Okay. How management in management buyout or buy-in, how they will manage the funds? Some of the funds will be arranged from venture capital. Some of the funds will be arranged by management by themselves. Both will contribute in equity. And remaining funds will be borrowed from financial institutions. Financial institutions. They will borrow. And the major threat is they have to keep the debt equity ratio at certain level. They have to keep debt equity ratio at certain level. That is the real challenge. So is the management buyout. Reason for buyout. Why companies do the buyout? Subsidiary is not the main or the core area. Subsidiary is a peripheral activity, not the main activity. So that's why you are selling it. Group may wish to sell off a loss-making subsidiary and the management wants to buy it. Parent company may need to raise cash quickly and the management are there to give you the cash. Best offer price might come from the small management group. So that's why you're selling to the management. The sale can be arranged more quickly than a sale to the external party. That's why you're selling to the management. Selling organization is more likely to be able to maintain beneficial links with the segment sold to the management rather than to an external party. This is the, again, if I'm the owner and I'm selling to the management, what is the benefit which I will get? I will get the cash quickly. I can get the best offer. I am selling to the known buyers. Plus, if I'm selling you, I can create beneficial links. For example, I will tell you that, okay, I'm selling you the business. I'm selling you the company, but you have to buy the raw material from me. Beneficial link. Okay, I'm selling you the company. You have to take the management advice from me. You have to buy a certain thing from me. But if you're selling business to the external party, you cannot dictate the terms. So that beneficial links is the advantage for the previous owners. Problem with the buyout, manager have a little or no experience of entrepreneur skills. That's a real problem. Management are doing the job. So it will be difficult for them maybe to run the overall business as an entrepreneur. Difficulties in deciding on a fair price to the bid, because if you are running the business, what will be the fair price? That will be the challenge. Because you know the ins and outs of the company. You know the problems of the company. Convincing employee of the need to change working practices. Now, as the management has become the owner, so now it will be difficult for you to convince all the other employees who are not in the management to change the habits. Inadequate cash flow problem will always be there because management is not that much rich in cash. Maintenance of previous employee pension rights will be a problem because you do not have enough money to keep the pension fund running. Accepting the board representation from all sources of finance provider will be difficult for you. For example, you as a management have to raise funds from venture capital. Venture capital will demand that I will sit on the board. You will borrow from the banks. Banks will demand I will sit on the board. So it will be difficult for you to put all the persons on the board. Maintaining continuity of relationship with supplier and customer is difficult because now the ownership has changed. Maybe key employees can leave the company. Okay, we have discussed that. Management buy-in, we have discussed. This is important. Share repurchase, triple bottom line. You can read it. So that's the major point, major discussion of restructuring. So guys, do you have any question from this area? Please ask. Okay, the number one requirement, calculate the valuation of the wood craft business in the three projected scenario. 9 marks. B part. Based on part A, discuss the possible courses of action that F company board could take regarding the woodcraft business. Discuss the possible course of action that F company board may consider, recommend what the course of action should be. Professional marks will be awarded for the demonstration of skills in analysis, skepticism, and commercial acumen. Okay, let's start reading the question. F company is a company which carries out agriculture and woodland management. F company also has a wholly owned retail subsidiary, Crownwood, with the board of the two companies having the same directors. Crownwood company runs two businesses. First business is Countryside Stores, which sell outdoor clothing and accessories. The second is a woodcraft business. This sells furniture and other products made of wood. The wood is sourced from the woodland managed by the F company. The wood is made into furniture and other products in craft center and sold in woodcraft shops, both owned by a Crownwood company. The craft centers are staffed by skilled craftsmen assisted by apprentices. There are some online sales of the products sold in the Countryside Stores, but woodcraft products are not currently sold online. Okay, the F company group will have to make a significant investment expenditure over the next few years. Profit from the woodcraft business have declined in recent years, and in the year just ended, woodcraft business made its first operating loss. F company board believes that without additional investment, there is a significant risk that woodcraft business will continue to make losses over the next few years. As the board also wants the F company group to have a greater focus on its core activity of agriculture and woodland management, it initially decided to close all the woodcraft shops and craft center. Okay. However, the proposal has been faced significant opposition due to the loss of jobs and adverse media coverage. A group of shop employees backed by a couple of wealthy business angels in a crowdfunding campaign have offered to buy out the woodcraft business. Crowdfunding is there are online websites where you put your idea and different all the crowd will give you the investment. All the people will start giving you the investment on through those websites. The consideration offered based on a recent year result and the funding available is $3 million. F company board has asked the group finance director to consider the three valuation which relate to the three projected scenario and based on net proceed from closing all the craft center and woodcraft shop and selling their asset individually. That's the number one. Expected free cash flow of the craft center were kept open, woodcraft shop closed, and the products made in the craft center were sold in the Countryside Stores and online. Okay, you will keep the craft center open and woodcraft shop closed. Expected free cash flow of the craft center and woodcraft shop stayed open. A necessary investment was made in them. This scenario will provide a comparison to the offer made by the buyout group. Investing in the craft center and woodcraft shop is not an option which F company board is currently considering. So what is the scenario actually? F company is a company which is doing the agriculture and woodland management. F company has subsidiary that is Crownwood. Crownwood is doing two businesses. In one business is countryside store. Second is a woodcraft business that sell furniture. And other is craft center. You made furniture and craft center. The wood is made into furniture. Other product is in craft center and sold in woodcraft shops. Okay, now F company is considering different scenarios what to do with this. Number one is net proceed from selling all the craft center and woodcraft shop and selling their asset individually. This is like closing the business, number one. Second is expected free cash flow of the craft center were kept open. Craft center will kept open, woodcraft shop closed, and the product made in the craft center were sold in the countryside stores. Third is expected free cash flow of the craft center and the woodcraft both will stay open, and company will put more investment in that. Okay, these are the three scenarios. Okay, this is the case. Close all the craft center and woodcraft shop and sell the asset individually. This is the financial position. Total net asset of the woodcraft business can be assumed to be 60%. Realizable value this. Okay. Close the woodcraft shop business, keep the craft center open and sell the product made in the craft center, the countryside store. There would be an immediate net cash inflow of this and forecast figure will be this. Okay, you need to create the present value and this is the third scenario. So what we have to do, we have to do the valuation of all the three scenarios. We have to do the valuation of all the three scenarios. So let's solve it one by one. Please open the spreadsheet, guys. Okay, number one is scenario number one. That is close all the craft center. Now add all the assets, realizable value. Total assets is 7570. Total liabilities 970. Net assets 6600. The net asset of the woodcraft business can be assumed to be 60% of the Crownwood total net asset. Net assets of the woodcraft business can be assumed to be 60% of the Crownwood net assets. The realizable value of the woodcraft shop and craft center can be assumed to be 75% of the woodcraft business net asset, taking into account the cost of the closure. So we have taken all the assets, we have taken all the liabilities. It is written that net asset of the woodcraft business is 60% of the Crownwood total assets. Okay, that means if this is our total net assets, woodcraft will be 60% of this. And then net assets of woodcraft business. %60. And the realizable value of that is 75%. So this is the realizable value. Part A is done. Part 2. Scenario 2. Okay, assume that there would be an immediate cash inflow of 800,000. Taking into account of asset sale, shop, closure cost and necessary investment. By the way, what is the scenario 2? We will close the woodcraft shop. We will keep the craft center open and sell the products made in the craft center in the store online. After tax profit is given, additional investment is given. Assume that additional investment for each year is equal to the depreciation in that year. From year 6 onwards, after tax profit and additional investment would be expected to be same as in year 5. So that means from year 6 onwards, there will be a perpetuity. Cost of capital is 12%. So let's take that 000 round off. We have to calculate the present value of these. After tax profits. By the way, guys, profit is given, additional investment is given. And at the same time, examiner has also stated that depreciation is equivalent to the additional investment. So will we deduct the capex and add back the depreciation, or we will do nothing? Please tell me. We will do nothing, right? We will do nothing. So these are equal to free cash flows. 470. $494, 516, 536, 558. Okay. Now discount at 12%. Present value of cash flows from year 1 to 5. NPV bracket start 12%, comma, select all 5 cash flows. This is the present value. Present value of cash flows after year 5. You will take the 5th year cash flow, divide with discount factor 0.12 into last year discount factor, that is 50. That is 50. Plus add the immediate cash inflow, 800. So the total worth will be this. Total value. Assumption. It is assumed that depreciation is equivalent to net additional investment and netted off against each other. Okay, year 5. I have applied the perpetuity. I have taken the last year cash flow divided by perpetuity factor 0.12 into last year discount factor. Discount factor, if cash flows are starting from year 6, last year discount factor will be 5th year. 5th year. Okay. Now, last is third scenario. Investment is 600,000, after tax profit, depreciation from year 4 onward. It's very simple also. After tax profits 380, 420, 440, depreciation 170. We will add back the depreciation, guys. 190, 200. Capex minus 300, minus 250, minus 210. Free cash flows. Present value of cash flows from year 1 to 3. NPV 12%. Of cash flows after year 3. So you will take the last cash flow into growth 1.03 divided by cost of capital minus G into discount factor of last year 1.12 raised to power minus 3. 3502. Okay, investment is 600. So the net will be this. That's how you will calculate it. Okay. After year 3 is simple. I have simply apply the discount factor 12% discount these. From year 4 onwards, I have done, take the last cash flow into 1 plus D 1.03 divided by cost of capital, that is 12%, minus G, that is 3%. And now discount this with the previous year discount factor. Complete. Okay, now let's discuss the other part, the B part. I have already written that. If you read the requirement, based on part A, discuss the possible course of action that F company board could take regarding the woodcraft business. So what will be the possible course of action that company board could take regarding the woodcraft business? Discuss other possible course of action that company board may consider and recommend what the course of action should be. So how you will approach the answer? You will discuss each scenario, the number 1 scenario, the number 2 scenario, the number 3 scenario, other option, then you will write the recommendation. So let's read it. This is totally written by me in my own wording. Obviously, you can use you can use your wording, and you can also read the examiner answer to get the proper understanding, and you can also use the typical wording of the examiner. Number one option was complete. Close the complete woodcraft business. Okay, what value you are getting in that case? 2970. 2970. If F company sells the complete business, it will generate an inflow which will help the business in achieving the desired goal. You will sell the business, you will get the inflow, you will use that inflow and invest in other areas. The value estimated by the realizable value method is the minimum value obtained by the business if you sell business asset one by one. Guys, there is a word used for this minimum value. Remember, floor value. Realizable value is actually the floor value of the business. If you sell the business one by one on piecemeal basis, that means 2970 is the value you will get if you sell the business at a minimum price. This is the minimum price. This is the minimum price. Okay, if F company sells the woodcraft business completely, company can focus more on core areas, other areas, and generate more business in the future. Okay, remember, whenever there is a word discussion, guys, always discuss the case by writing the positive side and the negative side of it. Always write the positive side and the negative side of it. Remember? Okay, now the negative side. If company sells the complete business, it will result the loss of jobs of craftsmen, which will create loss of reputation, as media will highlight this. And it will damage business image as well. The realizable value will depend upon the accuracy of data. Realizable value. It's not realizable value. Depends upon the accuracy of the data. It may not result in exactly the same way. F company may face the opportunity loss if the woodcraft business turns into profitable next year. Obviously, if you sell the business, and for example, if I bought this business and I turn this business into profitable venture, you will face the opportunity cost. Second, close the woodcraft shop, keep the craft center open, and sell the product made in the craft center in countryside store and online. This scenario will generate some cash receipt. And how much the cash receipt, by the way? 5276. This scenario will generate some cash receipt which will help the business growth. As we are keeping the craft center open, so there will be no loss of jobs. So loss of jobs will be avoided here. No reputational loss. Company can avoid the running cost of the shops by closing all shops of woodcraft. There are lots of issues which need to be addressed, like if company has no experience of selling online furniture products. How you will sell the online furniture products, craft centers, and how company generate revenue by selling online and on countryside store. Company have to manage storage cost of furniture as companies no more own the shops. You have sold the craft shop, woodcraft shop, and in order to sell online, you need some storage houses. Okay, if company is selling the products online, company have to manage the delivery cost as well. There is no discussion of delivery. Guys, in my house, even my wife is running an online page that is for the home accessories. My wife is doing the business that is of home accessories, and she's selling on different platform. One of the major platform is Facebook. So in order to sell online, um, she has to buy the inventory in advance. She have to store that inventory in the upper portion of my house. Obviously, we have assigned one room for that. So I have to bear the storage cost, at least opportunity cost, because nobody is using that room. Second, whenever we sell online, we have to bear the delivery cost as well. So this should be addressed. This case is better than the part of better than the part A financially, but obviously it depends upon the accuracy of the data that in future company is going to achieve these cash flows. Last part, keep all the craft center and bookshop open and make the necessary adjustment. What is the benefit you will get? 3719. In this option, company valuation is 3.72 million, which is above the sale offer of a buyer group. Buyer group is offering you how much? Buyer group is offering 3 million. So this is above that. If company keeps the business open, company can avoid the job losses and reputational loss. If the company is able to turn the business into profitable, that will help the business. However, company should consider the following points. In this part, we have to arrange the investment and how company manage that. Remember, we have to arrange 600,000. How you will arrange that? The valuation depends upon the accuracy of the data, that is company will achieve 3% growth. Will you achieve that? That's the question. So if we compare 3.72 valuation with lots of assumption with 3 million, 3 million is still good, because in order to achieve 3.72, you have to do a lot of work. And if you sell the business at this stage, you can immediately get 3 million. If you sell the business completely, you can avoid job losses and bad reputation, because you are completely selling the business to the other party. Now other party will absorb all the jobs and your reputation will not be at stake. So this is the other options. And then recommendation. Other option can be negotiate with buyer group and get higher offer. Negotiate with the buyer and ask the buyer to increase offer from 3 million. Wood business is in loss for the first year. It is wise to wait for few years. Sell the business to buyer at a better price and focus on core activity. Do not sell the business completely. Sell those shops which are in losses. Not all the shops are in losses. So do not sell all the shops. Recommendation can be different. Sell the buyer group at a better price. If you keep the craft business open, company should focus more on generating sales through countryside and all. Why this is recommended? Because there was a we were getting higher price from this. So guys, actually it is a game of writing the theory. And if you focus, there were 3 options in A part. And in B part, I have written all the 3 options. Why? Read this. Based on part A, discuss the possible courses of action. So there were 3 courses of action in part A. So I have given heading the part A, part B, part C. And how I have discussed the pros of that part, the cons of that part, the pros of second part, cons of second part, advantage of third part, disadvantage of third part. Then in requirement, examiner also said that discuss other possible course of action. I have assigned one paragraph for that. And then I have recommended the final course of action. That's how you will write the theory in exam. Sir, why pros and cons? Because if you only write the pros, that means you are not covering the skepticism and commercial acumen. Right? Like this is commercial acumen. Although we are getting 3.72 million valuation, but that 3.72 million valuation will come by many efforts, by taking many assumptions. Supplier offer is 3 million. The buyer option is 3 million. So it is wise to accept that 3 million. That is commercial acumen. That is skepticism. Okay. This is, it is written that 3% growth will be achieved. How you will achieve that growth? That is skepticism. So you have to write all the pros and cons of every case. That's how you will write in exam. Okay, everyone. Is there any question, guys? Thank you so much for joining in. Take care, guys. See you tomorrow at 7 p.m. And do revise currency risk management and interest rate risk management before tomorrow class. Thank you so much. Take care.